Enbridge Inc. (ENB) operates as a critical infrastructure backbone for North American and European energy markets, possessing a strong competitive position derived from its essential role in energy logistics. The company's business model is fundamentally defensive, characterized by highly regulated assets, long-term contractual structures, and volume or capacity-based fees. This stability underpins its appeal as a high-quality infrastructure investment, suitable for portfolios seeking reliable income and inflation protection. The core investment thesis for ENB centers on its compelling high-yield proposition, currently ranging between 5.9% and 6.5%, which is fully supported by robust distributable cash flow (DCF) streams. Dividend sustainability is further reinforced by management's consistent adherence to a conservative payout ratio target, strategically set between 60% and 70% of DCF. This discipline allows for substantial cash retention to support the company's aggressive growth initiatives. Financial guidance for the 2025 fiscal year remains stable and robust, affirming adjusted EBITDA expectations between $19.4 billion and $20 billion, with DCF per share projected to land between $5.50 and $5.90. This guidance provides a solid foundation for evaluating future shareholder returns. While the company carries a high absolute debt load, resulting in a debt-to-equity ratio of 147.9%, the primary financial mitigant is the meticulous management of operational leverage. As of Q3 2025, the debt-to-adjusted EBITDA ratio stood at 4.8x, placing it squarely within the company's strategic target range of 4.5x to 5x. Maintaining this level is paramount as it secures ENB's critical investment-grade credit status, BBB+/BA2. The long-term outlook is highly positive, projecting an acceleration in DCF growth to approximately 5% annually post-2026, driven by the $35 billion secured capital backlog. The analysis assigns an overweight rating to ENB. The predictable, escalating DCF growth profile, combined with an attractive, well-covered dividend yield, justifies inclusion as a core income holding. Investors must, however, maintain continuous surveillance of specific regulatory risks, most notably the ongoing legal challenges related to the Line 5 pipeline system. Business overview and strategic positioning. 1.1. Core business segments, geographic footprint, and revenue mix. Enbridge is a diversified energy infrastructure leader operating across 4 distinct integrated business segments that span North America and Europe. This operational diversity is a key factor in mitigating localized regulatory or economic risk, creating deep structural resilience across the portfolio. The segmented nature of the company ensures that potential regulatory or economic hurdles impacting one division, such as liquids pipelines, are offset by the highly stable, non-cyclical cash flows generated by the regulated gas utilities segment. This balance is the fundamental defense mechanism supporting the company's sustained status as a dividend aristocrat. The liquids pipeline segment operates North America's longest and most complex liquids transportation system, encompassing approximately 18,085 miles, 29,004 kilometers of active pipe. This segment is crucial, providing essential egress for crude oil from the Western Canadian Sedimentary Basin to key refining markets. The natural gas pipelines, transmission, midstream, and LNG division is focused on connecting prolific supply basins to major North American population centers and growing LNG export facilities. This segment is strategically positioned to capitalize on growing global demand for natural gas, particularly through critical projects like the connection to the Woodfire LNG facility. The gas utilities and storage segment represents the most rate-regulated and predictable portion of the business. It serves a vast customer base, reaching 7.1 million customers across North American jurisdictions, including Ontario, Ohio, and North Carolina. This network includes significant storage capabilities, featuring 351.6 billion cubic feet (BCF) of net working storage, predominantly anchored at the Dawn Hub in southwestern Ontario. The regulated utility framework provides the most reliable foundation for ongoing rate base expansion. Finally, the renewable energy segment showcases the company's commitment to diversification. Since 2002, Enbridge has committed $7.8 billion to renewable energy and power transmission projects. This portfolio currently totals over 3,500 megawatts gross, 2,500 megawatts net of zero-emission generating capacity, including North American solar projects and European offshore wind assets. 1.2. The low-risk commercial model and strategic tenets. Enbridge's primary strategic objective is maximizing stakeholder value by operating under a low-risk commercial framework. The vast majority of its cash flow is derived from regulated assets or secured by long-term take-or-pay contracts. This commercial construct fundamentally separates ENB from upstream commodity producers. Its revenues are driven by volumes moved and capacity reserved, not directly by volatile commodity prices. This focus on operational excellence and utilizing regulatory certainty provided by these commercial structures ensures predictability, which is highly prized by credit agencies and institutional investors. 1.3. Corporate transition strategy bridging conventional and low-carbon future. Enbridge employs a dual strategy aimed at maintaining the reliability of conventional fossil fuel transportation while concurrently advancing low-carbon energy technologies. The long-term corporate commitment is ambitious, achieving net zero emissions from its operations by 2050. This strategy involves pioneering new low-carbon solutions, including hydrogen, renewable natural gas, RNG, and carbon capture and storage. These low-carbon infrastructure (LCI) investments, while small relative to the conventional capital backlog, are strategically positioned not merely as diversification plays, but as key components to extend the lifespan and relevance of core conventional assets. For instance, investments in CCS infrastructure, such as the Pelican CO2 hub, $0.3 billion, directly mitigate transition risk for heavy industry clients served by existing liquids and gas systems. Similarly, RNG projects like Longview RNG, $0.1 billion, future-proof the gas distribution rate base by introducing cleaner fuel sources, thereby ensuring the long-term viability of the utility infrastructure in a decarbonizing economy. Financial performance and forward guidance. 2.1. Analysis of adjusted EBITDA performance. In assessing the financial health and operating capacity of a large midstream company, the focus must shift away from pure GAAP earnings toward operational metrics like adjusted earnings before interest, income taxes, depreciation and amortization, adjusted EBITDA, and distributable cash flow, DCF. This is essential because the capital-intensive nature of pipeline and utility operations often results in large non-cash depreciation and amortization expenses that skew traditional GAAP measures. For the third quarter of 2025, GAAP earnings attributable to common shareholders were $0.7 billion, while adjusted earnings stood significantly higher at $1 billion. Operationally, the company reported strong results, with Q3 2025 adjusted EBITDA reaching $4.3 billion, representing a slight increase from $4.2 billion in 2024. This performance provides confidence in the company's ability to achieve its full-year guidance for 2025. 2.2. DCF per share, the midstream metric of choice. DCF is the primary measure utilized by management and investors to evaluate the cash available for distribution, debt servicing, and capital retention. The company reaffirmed its 2025 financial guidance for DCF per share, projecting a range between $5.50 and $5.90. This DCF projection provides high visibility regarding dividend security. Using the annualized 2025 dividend of $3.77 per share, even the low end of the DCF guidance, $5.50, confirms that the dividend is well covered, aligning comfortably within the targeted 60% to 70% payout ratio. 2.3. Growth trajectory analysis, near-term and long-term. The company's growth profile is bifurcated, reflecting the massive capital deployment underway. The short-term outlook, 2023-2026, projects robust adjusted EBITDA growth of 7% to 9% CAGR, but the corresponding growth for DCF per share is expected to lag significantly, approximating only 3% CAGR. This constraint is not indicative of operational weakness, but is instead a consequence of the current major investment cycle. High capital deployment during this phase leads to initial capital drag and higher interest expense before assets become fully operational, temporarily depressing near-term DCF growth rates. The critical long-term outlook, post-2026, shows a projected acceleration to approximately 5% annual growth across all key metrics: adjusted EBITDA, adjusted EPS, and DCF per share. This acceleration is crucial for justifying the stock's current valuation premium and signaling the maturity of the current major investment cycle. As large capital projects such as the Woodfibre LNG connection transition from consuming capital to generating stable, high-margin cash flow, the 5% growth premium becomes feasible. Furthermore, management's commitment to reaffirming the DCF and EBITDA guidance multiple times in 2025 provides exceptional transparency and reduces uncertainty related to forecasting. This predictability is highly valued in infrastructure investments and contributes positively to the stock's defensive valuation premium, solidifying trust in the reliability of the underlying cash flow model. Capital structure and financial resilience. 3.1. Detailed balance sheet analysis. Leverage ratios. As a major midstream infrastructure entity, Enbridge necessarily utilizes significant financial leverage. The company's total debt stands at CA $101.1 billion against total shareholder equity of CA $68.4 billion, yielding a high debt-to-equity ratio of 147.9%. It is also noted that this ratio has increased substantially over the past 5 years, rising from 96.5%. Furthermore, the debt-to-capitalization ratio, 59.6%, is marginally above the industry average of 56.1%, confirming a structurally high debt position compared to peers. 3.2. Leverage management. Debt to adjusted EBITDA. Despite the high absolute debt figures, management's ability to control operational leverage is the key determinant of financial resilience and credit quality. The primary metric of focus is the debt-to-adjusted EBITDA ratio, which stood at 4.8x as of Q3 2025. This ratio is meticulously maintained within the company's stated strategic target range of 4.5x to 5.0. The high debt load is structurally mitigated by the regulated nature of NB's assets, which ensures exceptional cash flow predictability. This stability allows the underlying cash flow stream to be treated by lenders and credit rating agencies as highly secure, similar to a guaranteed utility payment stream. This high level of cash flow certainty enables the company to maintain an investment-grade rating, despite a leverage ratio 4.8x EBITDA that might be considered high in less stable industries. 3.3. Interest coverage and debt servicing capacity. A closer look at debt servicing capacity reveals some areas of strain, typical for a capital-intensive entity. The interest coverage ratio, calculated on an EBIT basis, is weak at 2.3x. Moreover, the company's debt coverage by operating cash flow, 12.8%, is also considered insufficient. While these figures are concerning in isolation, the context of the business model is critical. The weak EBIT coverage is largely a function of significant non-cash depreciation and amortization expenses. The true servicing capacity is better reflected by the robust and highly predictable DCF stream, minimizing the near-term concern but increasing sensitivity to future interest rate spikes. 3.4. Corporate credit rating stability. The company's ability to access capital markets affordably is secured by its investment-grade credit ratings. Senior unsecured debt is rated BB+ by S&P and Baa2 by Moody's, with a stable outlook from both agencies. This stability is essential for funding the substantial $35 billion capital backlog at a favorable costs. Maintaining the 4.5x-5x leverage target while financing this massive capital program requires precise capital allocation. Given the sheer scale of investment, the capital plan relies on retaining the 30 to 40% of DCF not paid out as dividends and adhering to an equity self-funding model, which necessitates disciplined equity issuance or asset recycling to offset new debt and prevent the leverage ceiling from being breached. Growth drivers and capital allocation. 4.1. The $35 billion secured capital program, segment allocation and delivery. Enbridge's primary growth engine is its secured capital program, which currently stands at $35 billion. This extensive backlog provides high cash flow visibility through the end of the decade. Management is also evaluating an additional $50 billion in diversified future investment opportunities through 2030. The $35 billion secured program strategically balances expansion in traditional hydrocarbon transport with foundational regulated utility growth and targeted low-carbon infrastructure deployment. 4.2. Deep Dive Conventional Expansion Projects. The majority of the capital program is directed toward conventional expansion, confirming that ENB's near-term strategic priority is maximizing returns from existing hydrocarbon value chains. In liquids pipelines, expansion projects are focused on enhancing market access for the WCSB, including the Mainline Optimization Phase 1, adding 150 kbpd, and the new Southern Illinois Connector, $0.5 billion US. The gas transmission segment is receiving substantial investment to capitalize on burgeoning LNG and export demand, particularly targeting the Pacific Rim and Gulf Coast markets. High-value projects include the connection infrastructure for Woodfibre LNG, $2.9 billion US, and significant Canadian pipeline expansions such as the T-South expansion, Sunrise, $4 billion CAD, and T-North expansion, Aspen Point, $1.2 billion CAD. Gas distribution continues to provide stable, rate-based expansion through predictable utility investments, including U.S. utility growth capital, $3.1 billion US, and Canadian utility growth capital, $1.6 billion CAD. This segment reliably supports the foundational cash flow profile of the company. 4.3. Strategic Low-Carbon Investment (LCI) Analysis. While conventional projects dominate the near-term capital spend, the LCI component is strategically focused on long-term relevance. The renewable segment investments include the Sequoia Solar Project, $1.1 billion US, Clear Fork Solar, $0.9 billion US, and the European offshore wind project Calvados, $1 billion CAD total capital. Crucially, the company is using its existing pipeline infrastructure to pivot into new low-carbon revenue streams. This includes the Pelican CO2 Hub, $0.3 billion US, a joint venture with Occidental Petroleum for carbon capture and storage, and the Longview Renewable Natural Gas RNG project, $0.1 billion US. These tactical investments in CCS and RNG utilize existing midstream expertise to secure future stability rather than immediately dominating revenue generation. The significant volume of U.S.-denominated projects, e.g. $3.1 billion US in utility growth, $2.9 billion US in Woodfibre LNG infrastructure, and $2.8 billion US in the modernization program, is noted. This heavy reliance on the U.S. market increases the company's exposure to U.S. political and regulatory environments, amplifying risk related to cross-border permits, export facilities, and potential trade policy changes. Shareholder return and dividend sustainability. 5.1. History as a dividend aristocrat. Enbridge boasts an exceptional track record of shareholder return, recognized as a dividend aristocrat with 30 consecutive years of dividend increases. Over the past 30 years, the dividend has grown at a 9% compound annual growth rate. The most recent announced increase raised the dividend by 3.0, resulting in an annualized payment of $3.77 per common share, effective March 1, 2025. 5.2. DCF payout ratio and coverage. Dividend sustainability is anchored by the aforementioned DCF payout ratio target, 60% to 70%. By retaining 30 to 40% of its DCF, the company maintains sufficient capital to fund the equity portion of its large organic growth backlog, consistent with its equity self-funding model. The current modest 3.0 dividend increase aligns directly with the constrained 3% near-term DCF growth. This alignment indicates that management is prudently prioritizing the balance sheet, maintaining 4.8 leverage and capital retention required to fund the $35 billion backlog. This fiscal constraint on dividend growth is temporary. Once the DCF growth accelerates to 5% annually post-2026, dividend increases are highly likely to accelerate accordingly, enhancing the overall total return profile for investors.
5.3. Comparative dividend yield and total return. ENB's forward dividend yield at 6.5% represents a significant premium over the composite industry average of 5.3%, positioning it as a highly attractive income vehicle within the midstream sector. Management explicitly communicates that this sustained dividend growth has not been achieved at the expense of financial strength. By explicitly linking dividend sustainability to the DCF payout ratio and rigorous leverage control, the company proactively addresses concerns related to its high debt load, reinforcing the predictability and long-term soundness of the dividend for income-focused investors. Section 6. Key Regulatory and Non-Financial Risks, ESG. 6.1. Critical Litigation and Regulatory Headwinds, Line 5. The most material, unquantifiable regulatory risk facing Enbridge centers on the Line 5 pipeline system, particularly the dual segment located beneath the Straits of Mackinac. This infrastructure is vital for delivering crude oil across the border. The project faces severe legal and regulatory uncertainty following Michigan's revocation of the Straits easement. Furthermore, 4 tribal nations filed notice in December 2023 to appeal the Michigan Public Service Commission's MPSC approval for the proposed tunnel project, following years of opposition and the Bay Mills Indian Community's resolution to banish the pipeline from tribal lands. Compounding the project timeline uncertainty is the requirement by the Army Corps of Engineers for an environmental impact study. For a project as contentious as Line 5, the IIS requirement serves as a de facto delay mechanism. The study process is inherently lengthy and opens the door for additional legal and political challenges, ensuring that the necessary infrastructure upgrade remains a protracted regulatory battleground. This situation represents an unquantifiable tail risk that could permanently raise the cost of capital or, in the worst case, lead to the forced shutdown of a critical piece of North American energy infrastructure. 6.2. Policy Risk and Tariffs. As a company deeply involved in cross-border energy logistics, Enbridge is exposed to policy risk stemming from potential shifts in North American trade policies that could impact the flow of oil and gas. While management has stated that it does not expect tariffs to have a material impact on current operations or capital deployment, the increasing reliance on U.S. markets, highlighted by the volume of U.S. dollar-denominated growth projects, increases the overall sensitivity to shifts in regulatory and trade policy. Valuation and peer comparison. 7.1. Relative valuation multiples. An analysis of valuation metrics suggests that Enbridge trades at a premium reflective of its status as a stable, regulated infrastructure entity with high dividend visibility. The price-to-earnings (PE) ratio stands at 23.2x, making ENB expensive compared to the peer average of 16.5x. This premium indicates that the market highly values the predictability, regulated nature of the company's earnings and the reliable high dividend yield, accepting a lower earnings multiple in exchange for cash flow security. The enterprise value to EBITDA, EV/EBITDA ratio, is approximately 15x on a last 12 months LTM basis. While the forward EV/EBITDA multiple is slightly above its 5-year average, 3.20%, this valuation is generally consistent with that of high-quality, fee-based infrastructure and utility assets. The forward price to distributable cash flow (PDCF) multiple, using the midpoint of the 2025 DCF guidance, $5.70 per share, serves as the most accurate measure of relative value for a midstream company. The high degree of investor confidence in this DCF guidance is notable. However, given that the range is relatively tight, $5.50 to $5.90, any failure in project execution or cost overruns within the $35 billion backlog that necessitated a downward revision would disproportionately impact the calculated PDCF multiple, potentially leading to a sharp re-rating as DCF reliability is the core determinant of ENB's value. 7.2. Analyst consensus and price targets. Analyst sentiment is generally favorable, with a consensus rating of moderate Y. Price targets range from $49.38 to $49.66. These targets suggest an expectation of only modest capital appreciation in the near term. Combined with the high valuation premium, 23.2x, and constrained near-term DCF growth, 3% CAGR, this confirms that the total return profile for ENB is heavily weighted toward the high 6.5% yield.
The company is fundamentally positioned as an income-driven total return vehicle rather than a core capital appreciation play. Conclusion: Enbridge Inc. maintains a formidable position as one of North America's premier energy infrastructure operators, characterized by deep business diversification across 4 segments, including regulated utilities and critical liquids egress infrastructure. The structural advantages inherent in its commercial model, fee-based contracts, and regulated returns successfully mitigate the risk associated with a high absolute debt load, 147.9% debt to equity. The company's financial resilience is confirmed by its successful management of operational leverage, maintaining the debt-to-adjusted EBITDA ratio securely within the 4.5x to 5.0x target. The investment proposition is robust, driven by a highly secure and growing dividend, 6.5% yield, and high visibility into long-term cash flow growth derived from the $35 billion secured capital backlog. While near-term DCF growth is constrained to approximately 3% CAGR through 2026, the projected acceleration to 5% annually post-2026 is a compelling catalyst for total return maximization. The primary caution involves the material regulatory and litigation risks surrounding the Line 5 tunnel replacement project, where the requirement for an environmental impact study introduces profound uncertainty and extended timelines. Continuous monitoring of the judicial and political landscape surrounding this asset is mandatory. Based on the highly predictable income stream, the investment-grade status, and the anticipated acceleration of DCF growth after the current investment cycle matures, the rating remains overweight. ENB should be viewed as a foundational, high-quality, income-focused holding within a diversified portfolio.